The question that I'm trying to answer here, and it kind of goes to our question of the day, what is the bond market really pricing right now, is are we in a position where the Fed is going to be aggressive but not that aggressive because it's worried about causing an inflation, or is it going to have to cause an inflation because it's worried about a recession, or is it going to have to cause a recession in order basically to deal with inflation? I think that's what everybody's trying to get their arms around right now, and I'm getting really conflicting signals from various market participants. So let's try and get an answer to that question. Romaine, Bostic, co-host of Bloomberg Markets The Close. Ira Jersey, chief US rate strategist for Bloomberg Intelligence, joining us now. Ira, what are we pricing in now?
Yeah, so we're pricing in for basically 8 full rate hikes over the next year and a half or so, and you know, that means that the Federal Reserve is, you know, the market thinks that the Fed's going to go pretty quick here, and in fact, we're still priced for basically a hike at every meeting this year, and maybe, you know, a chance of a 50 basis point here at some point. I don't think that they'll be able to go quite that fast because of some of the risks that you mentioned to the growth outlook, but for sure, the market thinks that the Fed's going to hike and hike pretty aggressively.
Romaine, let's bring you into the conversation here because we have to talk about the geopolitical tensions at play. It wasn't too long ago where we saw the Fed, the hawkish Fed, kind of take a back seat for yields, and now that's kind of driving the narrative. What do you make of it?
Well, it took a backseat briefly here. We talk about where we were sort of in mid-February, where you saw yields basically peak out at least on the 10-year, above that 207 level. They dropped immediately after that because of the war in Ukraine, because everyone thought the geopolitics would sort of overwhelm inflation. Well, the problem now is that geopolitics are inflation. And of course, the war in Ukraine has proven that inflation is not only a problem, but probably a bigger problem than what it was before the war. And that's a big part of the reason why you're looking at yields right now, making these moves higher. It's a big part of the reason, Kriti, why you're looking at break-evens. The expectations 10 years out above 3%. The expectations 5 years out right now at 3.6%.
Romaine, what are stocks pricing? What is the stock market telling us? Is the stock market just a derivative of the bond market right now? Or is the stock market got any useful kind of signaling here? Stocks have remained relatively elevated through this. We've come down quite a long way, but you look at where we are in historical terms, we haven't come down that far. So just give me a sense of what you think the signal we're getting from stocks is. Are we going to get a recession? Are we not going to get a recession? Are earnings going to hold up? Are earnings not going to hold up?
I think the general consensus based on the pricing is that earnings aren't going to hold up. It's now a question, Guy, of how severe it's going to be. You think back a couple of months ago here, there was a pretty strong negative correlation between the rise in yields and the drop that we saw in stock prices. That correlation is still there, though not necessarily as strong as it was a couple of months ago. So I think when you see what happens on Wednesday with the Fed announcement, it's really going to be about two things. Not just whether we get a rate hike, but whether they decide to be a little bit more aggressive, go with 50 basis points. That's being priced out right now. But whether they communicate that going forward that, yes, there is a real scenario that we could see 6, 7, 8 hikes this year, and of course, maybe a faster drawdown of that balance sheet.
Ira, hop back in here into the conversation. I'm curious what this means when we're looking at things in terms of the commodity shock, because it kind of seemed like for a second the geopolitical situation, like Romaine said, was outweighing the hawkish Fed. Do we expect comments from Chairman Powell on simply what that commodity shock might look like and how long it might last?
Well, and I don't think he'll necessarily say how long it'll last, right? He'll say that it's unclear, that whenever you have these types of risks, that will continue to they'll continue to monitor the situation. But I think the answer to the question that he is likely to get asked, like you just mentioned, is, you know, that the Federal Reserve can only do so much. The Federal Reserve really controls the demand side of the balance sheet. So to Guy's point earlier when we were talking about what the Fed's going to do, the Fed basically can only drive us into a recession in order to get inflation lower, because it can only stop demand. I was just looking this morning at the number of gallons of gasoline sold because of how high gasoline prices are at the pump, and those have come off very dramatically. In fact, they're right at the lowest level that they've been about the last 5 years. So these higher prices are already crimping demand, and that's creating a tax on the consumer, which is going to slow real GDP and real economic growth going forward. But until that starts to hit the job job market, the Fed is going to feel it's okay to hike. Now, once the job market turns around, if you start to see job losses at some point and a slowing of wage growth, that's when the Fed has to be really cautious. And that's why I think like the Fed ultimately is going to go a lot slower than what the market's pricing for right now. Now, what that means, of course, is that maybe 2-year yields are getting to a point where they're not going to be able to go up as quickly as they had been. But I still think you're going to see a 2% 2-year yield at some point this year.
Romaine, I'm curious about the point that Ira just made here, the fact that the Fed can't tackle those commodity prices. They're not tackling the supply issues. They're tackling the demand, right? But I'm wondering if you kind of put the demand destruction that you're seeing from commodity flows on top of the Fed trying to kind of control demand, at what point does that become a double whammy? And at what point does that become even bigger odds for a recession?
Well, I think this is what the Fed has to address, and this is the conversation that's going to be had on Tuesday and Wednesday, is how do you sort of ease demand? You don't want to obviously destroy it. In the sense of what the Fed is trying to do. But how do you ease that in the face of, I guess, market forces that are already seem to be doing that right now? And to Ira's point, too, when we talk about kind of the feed through into the stock market here, you keep an eye on some of those discretionary names. And I think that's where you're going to start to see most of the pain. We've seen it there already. Remember, this isn't just about what you're paying at the gas pump. It's what you're paying at the grocery store. It's what you're paying to go out to eat. It's what you're paying when you go to the store to buy, new pants for your kids. These are really already being felt. You see it anecdotally, and it's eventually going to show up in the data.
Ira, we're going to get a dot plot. We're going to get an economic outlook from the Fed this week. How big an upgrade do you think we're going to see in terms of the rate picture from that dot plot? What is the Fed going to be signaling? And to come back to this point about the demand side of the economy, how high do rates have to go, do you think, before we start to see a meaningful impact on the economy? Where do you think that point is? Do we need to get into positive real rates? How high do nominal rates have to go before they start affecting the U.S. consumer, U.S. industry?
Well, I have to say a couple of things about that. There's a lot of pieces to that question. But I think that the big thing is we have to remember inflation on a year-on-year basis is going to be lower in 9 months than it has been the last couple of months, right? So just base effects alone are going to drive some of that. And certainly if oil prices even just stabilize right where they are now, you're going to have inflation that's going to be closer to 4%. Do we need to get real rates to the positive in order to feel the economic impacts of that? The answer is no. I think that we're already starting to see the economic impact of that. Certainly if you get mortgage rates that go up another 25 to 50 basis points, you're really likely to see the housing market slow pretty substantially. I know there's some supply issues. There's not a lot of supply of houses on the market, but at the same time, if you can wind up getting mortgage rates that get close to 5%, it's hard to see that not crimping demand for the housing market. So there's a lot of pieces to the puzzle. So the Fed, I think, is going to, what you're going to see in both the summary of economic projections and the dot plot is a wider dispersion of outcomes that members of the Fed think are going to happen. So you have people like President Wallard and Bullard say you're going to get significantly higher maybe interest rates in the out term, maybe even 3.5% in some cases, but then others that still think that the terminal rate's going to be somewhere in the low 2% area. So I think that dispersion is going to be what is going to be the story for the summary of economic projections and the dot plot this month.